In the realm of monetary policy, we have two main types of instruments: conventional and unconventional. Conventional instruments are the traditional tools used by central banks, while unconventional instruments are innovative methods used in extraordinary circumstances. Conventional monetary policy involves the central bank changing cash rate targets for a short-term interest rate, or also known as policy rate, to achieve economic objectives. Changes in these interest rates affect the cost of borrowing and the reward for saving, the exchange rate and the prices of some assets. This influences people's decisions to invest or consume, which ultimately affects economic activity. Consequently, by changing interest rates, conventional monetary policy helps a central bank achieve its goals for such things as aggregate demand, employment and inflation. For example, raising interest rates dampens growth in aggregate demand and employment and puts downward pressure on inflation, and vice versa. Through its interaction with commercial banks and domestic money markets, the Reserve Bank maintains the cash rate target. RBA cash rate provides a foundation of the interest rate structure in the economy. Before we move on to the main topic, let us revise the concept of inflation. Inflation is the rise in the general price level of goods and services in an economy over a longer period. This results in a decline in the value of money and purchasing power. If inflation is likely to be too high for too long, the Reserve Bank Board would typically tighten monetary policy, such as by increasing the cash rate. In reverse, if inflation is too low for too long, the RBA would typically loosen monetary policy by decreasing the cash rate. Low and stable inflation reduces uncertainty in the economy, helps people make saving and investment decisions, and is the basis for strong and sustainable economic growth. Now, let us begin with the conventional monetary policy tool. Prior to the COVID-19 recession, the cash rate target was the only actively used tool of monetary policy. The central bank plays a central role in setting cash rates by controlling the supply of money. In particular, the Reserve Bank typically managed the supply of S-balances. This mechanism ensures that the economy remains stable and inflation is kept in check. The Reserve Bank kept the cash rate on target by conducting open market operations. The availability of money in the S account determines cash rates. A high supply of funds leads to a low cash rate, while a low supply of funds results in a high cash rate. This balance is crucial for maintaining economic stability. When traditional tools are not enough, central banks turn to unconventional monetary policy. The emergence of the COVID-19 pandemic became an economic event of extraordinary scale across the world. In response to the economic effects of COVID-19, the RBA implemented a comprehensive package of monetary policy measures in Australia to support jobs, incomes and businesses. These unconventional measures are used to address extraordinary economic challenges, such as during financial crises. Unconventional instruments include forward guidance, term funding facilities, negative interest rates, asset purchases, and adjustments to the DMO. These tools help increase credit supply, manage interest rates, and stabilize the economy. Forward guidance is adopted when the RBA had committed to not increase the cash rate until actual inflation with sustainability within the 2 to 3% target range. It can be committed on time basis or state basis. Term funding facility, TFF, allows banks and other authorized deposit-taking institutions to borrow funding from the RBA for a period of 3 years at an interest rate equal to the cash rate target at the time. Banks use this funding to make loans to businesses and households. Asset purchase involves the outright purchase of assets by the central bank from the private sector, with the central bank paying for these assets by creating central bank reserves. Adjustment to DMO is made in response to severe economic conditions such as the global financial crisis in year 2007 to 2009, and later to the COVID-19 pandemic. The adjustment made include providing much larger amounts of liquidity to the financial system than before the crises, expanding the range of collateral, and increasing the range of eligible counterparties that they allow to engage in domestic market operations. The negative rates imply that instead of earning interest on money deposited in a bank, people would be charged by their bank to deposit money. In conclusion, both conventional and unconventional monetary policies play crucial roles in managing the economy. Understanding these instruments helps us appreciate the efforts made to maintain economic stability and growth.